Hello and welcome to Cap STRAT this week. Mike, this week we'll be zooming out a little bit. We spend a lot of time talking near-term views, near-term performance in these videos. I want to walk our viewers through a little bit longer-term strategic thought process that we execute on the portfolio management side. Figured we'd start with fixed income. We can go ahead and check in on both near and long-term historical returns here. Month to date, still green on the fixed income side, yields falling slightly. But what we want to focus on here are some of these rightmost columns. Since 2022, a lot of red there. 5-year, down 5% for the 30-year. What's important for us to take away from fixed income returns before we start talking fixed income valuations?
Setting up that longer term perspective, the primary determinant of your future returns is the price you pay today. The price of these assets for most of these areas of the fixed income markets have gotten significantly cheaper since the beginning of 2022. That, of course, is when the Fed started this rate hiking cycle. There's also been a tremendous amount of fiscal spend during this time period. Bond yields have gone up a lot. Prices have gone down a lot. So for the 30-year bond, the price you pay today, about 37% cheaper than what you would have paid at the end of 2021. And that equates to higher expected returns in the future. And then you go back to when we're going to talk valuations in long term. Well, we just said what we mean by valuations. It's what do current prices look like and how does that translate into future returns? What do we mean about long term is at least 5 years.
Right.
So over the prior 5 years, most areas of the fixed income markets giving you returns below their yield, which is key. In equities, we'll talk about something different, below trend. But your starting point is your yield. What was your yield at the beginning of this 5-year time period? Did you return in line with that or below that? That's sort of your benchmark going forward, your starting point. So a pretty miserable prior 5 years. But just remembering, when we look at trailing returns, it's not that fixed income has been miserable for 5 years. Fixed income had a miserable year that got averaged into the 5-year trailing returns. That miserable year was 2022.
Yeah. And you noted, the biggest driver, one of the biggest drivers of expected returns is the price you pay today, right? On the fixed income side, particularly for investment grade bonds, you can reasonably assume what the future cash flows are going to be, and you can calculate a current yield. And they tell you this nice, starting yield for your purchase price today. And from a long-term valuation standpoint on the fixed income side, current yield is a pretty good place to start.
Yep.
But obviously that's not the end all be all. And there's other adjustments we want to make to this yield based on expectations for change over the projection time horizon. So what does that process look like when we're coming up with our longer term expected returns for various fixed income asset classes?
We start with the expected yield on cash over the next 5 years. And how do we come up with that number? Well, we use the market, the Fed funds futures market. It's a very liquid market where market participants are betting over the next 1, 2, 3, 4, all the way out to 60 months what the Fed funds rate is going to be in that month. So when you ask the question, what's the consensus as to what the Fed funds rate is going to be 5 years from now? Well, it's 4.99%. You can see it's the very end of that black line, dashed being the forecast horizon. So that's the first thing you'll note. That's very high compared to the prior 15 years. Totally different environment. The market is no longer expecting that the Fed is going to be able to cut back down to something near 0%. Inflation has been far too stubborn for that. Nominal GDP growth has been far too robust. The labor market far too tight. The expectation is we are not getting back to zero. And that is the starting point. Every other area of fixed income, we assume that yields go from where they are today and then they revert to the average spread over cash. So if you're investing in a high yield bond, so when we say high yield, we mean below investment grade. These are companies that with a below investment grade rating. If you're going to invest in that bond, you should demand a higher yield than cash for a number of reasons. The credit risk, the lack of liquidity, the duration risk, right? This is a longer term bond. Something could happen to the company. If it's a 10-year high yield bond, they might go bankrupt. All of those reasons, you would demand a higher yield to compensate you for the risk. High yield bonds are the red line. If high yield bond yields revert to the average spread over cash from the prior 10 years, then they're going to end this forecast period with a yield of 10%, 10.08%. So if we know our starting yield, or current yield, and we know the path of yields over, well, we don't know, but we're projecting the path of yields over the next 5 years to get an ending yield, then we just do the math.
Yep.
If your yield goes from this to this, making some reasonable assumptions around, bond metrics like duration, convexity, et cetera, this is what your return will be if you buy and hold. And that's what we have all the way out in the table to the right, 5-year expected return. So you go down the line, cash expected to return 5.19% over that time period. That's extremely attractive. You should start, as a fixed income investor, you should look at all these things relative to inflation. And not just any inflation gauge. What's the inflation that you're likely to experience? Is your consumption basket leaning more towards healthcare? What has that been running at? Is your consumption basket leaning more towards food and energy? What's that been running at? But by any of those metrics, a risk-free cash yield of 5% is probably going to out-yield inflation.
Yeah.
That's a totally different environment.
Yeah, completely different starting
than
point.
we had from 2008.
Here.
Exactly.
Yeah.
And then, back in certainly different than 2021, where you were getting 0 and inflation was starting to run towards 6-7% year over year. So the math, if you're thinking about your future, you're thinking about your portfolio, you're thinking about how I beat inflation, totally different math going forward than the prior 15 years. And then other areas of the fixed income market, very productive relative to the prior 15 years. Out in high yield bonds, emerging market bonds, you're talking about 8.7% expected returns annualized for a high yield bond, and emerging market bonds at 7% annualized. Those are equity-like returns.
Yeah.
And the big reason why is because your future return, the price you pay today is the primary determinant of your future return. Prices are cheaper now. When you see these yields skyrocketing in 2022, if we were to turn this into a price chart, prices would be plummeting, right?
Yep.
Buy low.
Exactly.
Buy low.
And you can see not only is that a determinant of future expected returns, but also higher yields give you more room for error. And you can see that playing out here where you've got, EM bond yields rising, high yield yields rising, core bond yields rising, but still seeing some healthy, positive, absolute projected returns because that starting yield is so healthy.
Right.
It's not like we're starting with a 0% yield, and then if you get yields moving upwards, you're looking at negative returns, right?
That's a great point. When we assume that yield spreads over cash revert to their 10-year average, that's a pretty nasty assumption.
Yeah.
That means within high yield, if you own a basket of high yield bonds within a fund or an ETF, some of those companies are not going to make it.
Yeah.
That's baked into these assumptions. So relatively conservative from that point, not assuming everything is going to go great. But to your point, your yield is your buffer. It's your margin of safety.
Yeah, exactly. And I just want to point this out because this sticks out to me a little bit. But this little cut cycle here, it's a little itty bitty cut cycle, right? You're getting down to about 4.5% on the federal funds rate to some of the reasons you mentioned earlier. But this is what the equity market's getting all worked up about, right?
Yep.
This cut cycle is coming. It's going to save us. It's going to, increase returns for equities. And you can see that if we look at equity performance here, if we can find the right page. You can see month to date, equities still green across the board. Look at these 1-year numbers. This green is so dark it might be hard to see on the screen. But equity markets continue to rally pretty strongly. A little bit more of a mixed picture since 2022, and I think this will feed into our valuation discussion for these different areas of the equity market. But if you just look at some of these numbers relative to trend, large growth, 16% annualized since 2022. Compare that to small caps down 5% since 2022, right? A little bit more of a mixed bag.
Exactly. When we're talking about equities, the same thing applies. The price you pay today is the primary determinant of your future returns.
Yep.
But instead of thinking, well, did you outperform your starting yield or did you do worse than your starting yield? Now it's more, have equities outperformed their long-term trend or underperformed their long-term trend? If they've outperformed their long-term trend, they're getting more expensive.
Mhm.
They're becoming a victim of their own success, right? They're getting very pricey, which means future returns are going to be lower.
Yep.
If you've underperformed your long-term trend, that means you're getting relatively cheaper. You're getting more attractive. This is a valuation tool, not a timing tool, right? If you want to talk about timing, go back to any of our videos from the past however many months and weeks. So you look at the 5-year return numbers, most areas of the equity market near or below their long-term trend. So getting on the margin cheaper, not getting cheaper like bonds got cheaper. Bonds got a lot cheaper in a hurry.
Yep.
Equities, getting a little cheaper, with the exception of large growth. Actually got, almost doubled the long-term trend.
Healthily more expensive.
Right?
Yeah.
So over the past 5 years, annualizing a return that's double the long-term trend, that means getting very expensive. There has been, in our view, within our long-term framework, excessive risk-taking within that area of the market.
Yep.
The prices for those types of companies are very high relative to other areas of the equity market, relative to cash, relative to fixed income, et cetera. We've talked about that a lot.
Yeah, and so to that point, if we take a look at equity valuations, very similar thought process to the fixed income side, except now you're replacing current yield with long-term trend as your starting point, right? So you can see here we've got the various long-term trends laid out for these different asset classes, and then we overlay how far away are current prices from that long-term trend.
Right. And we'll take them in clockwise order. So you start with the NASDAQ 100, and we're going back to 1960. We know the NASDAQ 100 hasn't been around since 1960. We're using a proxy. We're basically talking about mega cap growth stocks in the US. And if you were to just plot that index, what you would get is an exponential growth pattern because, like we always say, compound interest is the 8th wonder of the world. So for the sake of valuation, what we do is we put that on a log scale. And what that does is it takes that exponential growth pattern and flattens it out into something more linear. That's your green line. Once you have that, you can draw a line of best fit or a trend line. That's our gray line. The slope of that is your long-term trend return. That's your starting point. If somebody were to ask, hey, what's your best guess as to what mega cap growth stocks are going to return over the next 10 years? You would say 10.55% annualized. Why? Because since 1960, that has been the average experience.
Right.
You haven't necessarily gotten that every year. In fact, you rarely do get that number in a given year.
Yeah.
But over the long term, if you're going to be an investor in mega cap growth stocks and you're going to take on that type of risk, you should demand something like a 10.5% return. But then the market goes through cycles of exuberance, fear and greed and so on and so forth. And so at any given point, the green line can be above trend, meaning it's expensive, or below trend, meaning it's cheap. And if we look at where we're at today, NASDAQ 100 is above trend. To put it in numbers, it's 39.68% above trend.
Yeah.
What does that mean? It means if over the next 3, 5, 10 years, NASDAQ 100 becomes a victim of its own success for some reason or another, what if it were to just very, in an orderly, methodical fashion, catch back down to its long-term trend? What would you get as an investor if that was your experience if you bought today? And if you bought and held over the next 3 years and you caught back down to trend, you would lose 5.95% annualized.
Yep.
If you held for 10 years, you'd make 5.51% annualized. That's not very attractive, especially given the risk and especially relative to the expected return on cash.
Yeah.
Why would you take all that extra risk and experience all this extra volatility for a 5.5% return when you could have gotten the same experience with no risk in cash?
Exactly.
So that, from a valuation standpoint, long-term, not an attractive asset class right now.
Yeah.
This is really difficult for a lot of investors to rationalize because for the past 10 years, this has been all you wanted to own. This has been your experience. You went through the tech bubble. This area of the market was no man's land until about 2010.
Yep.
In 2010, if you bought and held, that would be smart, right? You were below trend. All systems go. All these numbers would look different. All of these would be above trend numbers. You'd think, wow, I'm buying low. That experience through 2021, it was the best performing asset class in the world.
Right.
And then we got a bit of a valuation adjustment in 2022, and now we're right back to where we were, as expensive as we were at the end of 2021. Not as expensive as the tech bubble. That's pure bubble.
Yeah.
That's very bubblicious. We're not there yet, thankfully. But right now, if you're getting into NASDAQ 100, you're buying high.
Yeah.
If you're a momentum investor, it might not matter over the next 1, 3, 6, even 12 months. But over a 10-year time period, you're playing with fire.
Yeah. Yeah. It's kind of the opposite of those higher yields in fixed income. You have less room for error, right?
Yes.
Because you're buying at higher prices. So you're maybe not quite expectation, but it would be reasonable if you return to trend over some time.
Yes, you have very little margin of safety. Everything has to go perfect.
Yeah.
Not saying these are bad companies, but any company can become a bad stock if it gets too expensive. The expectations for these stocks are very high, and they have to deliver, or else you as an investor are going to get some disappointing returns. No margin of safety.
Yep.
So then you go around in clockwise fashion, large value stocks, the other side of the value growth spectrum, 8.5% long-term trend, makes sense. Most would say they're slightly less risky than mega
Right.
cap growth stocks, so you should expect a lower return. We're only 10% above trend, which means if you come back down to trend over the next 10 years, you get 7.5%. That's pretty attractive. It's reasonable.
Right.
It's certainly not turning anybody off from the asset class. And then we go to foreign equity, lower trend, below trend. So that's pretty reasonable, below the long-term trend. So if you come back to trend over the next 3 years, you're talking about 9.7% returns. That's pretty good.
Right.
And then finally, what we've been talking about for a while here, small value. Your long-term trend is almost in line with the NASDAQ 100, 9.85%, but you're 15% below that trend. So if you catch back up over the next 10 years, you're talking about 11.65% annualized returns expected over that time horizon. And anybody can look at this and say, well, this just seems like drawing complex lines on a chart, and say, okay, well, that's kind of what we do here. But the other thing you look at is the R squared number.
Right. Yeah.
What does that mean? That means what portion of the variability in this blue line is explained by this nice straight gray line. 91.9%.
Yeah. Look at those value R squareds.
So if you have a long time horizon, valuations matter. They explain a lot of your experience. If you have a short time horizon, they don't explain a lot of your experience. Other things matter, like inflation, economic growth, liquidity, recession.
Yep.
Those things matter much more over a 1-year time period. These matter much more over a longer term time period.
Yeah. And even in a place like NASDAQ 100 here, you're still looking at an R squared around 80%.
Mm-hmm.
But I want to highlight here, you mentioned it earlier, this is not a timing tool. This is a long-term valuation tool. And you can see, as in the tech bubble and as in recently, it's possible for these asset classes to stay above trend for some time, right? But we're using these numbers to kind of act as a starting point for us to gauge relative risk and return amongst asset classes when building portfolios. And so that takes us to this chart here, where we're putting it all together. And we're looking at these various asset classes. Your y-axis is expected return based on those methodologies we just talked about, and your x-axis is expected risk. And you can start to gauge these opportunities relative to each other in a portfolio building setting.
And of course, what you would want is something up here, but that doesn't exist.
That's the gold zone.
That would be called a free lunch. Doesn't exist in investing. So the next best you can do is anything above this gray line. Generally speaking, that's attractive return relative to the risk. So within our investment framework, how do we balance the long-term with the near-term? We don't want to contradict our long-term views with our near-term views. That's sort of a losing man's game, right? If we're at least directionally aligned with our longer-term views, now we're playing a winning game. Yeah. It might not work out immediately, but it should work out eventually. That's much better. So when you look at asset classes above the gray line across client portfolios, those are areas where we have been neutral or overweight relative to whatever the target weights are for that client. And then asset classes below the line, generally speaking, there we've been neutral to underweight.
Yeah.
And one of the least attractive in the risk return spectrum, once again, surprising probably to many, is the NASDAQ 100. You look at it, and here we go. Your expected return versus cash is very similar,
Yep.
but look at how much more risk you're taking.
Yeah.
It's just not a very attractive trade-off. Small value, yes, I'm taking more risk, but I'm getting significantly more expected return because I'm buying low.
Yeah.
I'm buying low.
Yeah. And that cash yield is critical, right? Because you look at this line of best fit, it's relatively flat.
Yeah.
Whereas a couple of years ago, we're looking at a cash yield around here, and you're looking at a line of best fit more like that.
Yes. Yes.
All of a sudden, you know, some of these asset classes, core bond becomes more attractive relative to cash, right? So,
right.
A game changer in terms of where cash yields are today and what that means for portfolio allocation and expected returns going forward.
Mm-hmm.
So taking it to those other factors that are going to drive more near-term performance, getting into the investment framework components, inflation, still the inflation projection to get down around target by early 2025. We get PCE reading this week.
Yep.
Markets will be excited to digest that.
Mm-hmm.
Expectations for a continued gradual decline in the monthly inflation rate.
Yep.
Liquidity forecasts relatively unchanged recently here. Still the expectation for liquidity to pick up in the back half of 2024. And then economic growth, 1.9% here. Atlanta Fed GDP now still 3.5% for this quarter. We talked a little bit about PMIs last week. Headline numbers showing some potential recovery in the PMI, but the employment picture still looking somewhat bleak.
Right. And those May preliminary PMI readings from S&P Global, huge recovery in the services sector from April.
Yep.
So, that's the problem with shooting these videos weekly. The information changes a lot. But the important thing that we flagged was the employment component within those PMIs. That is what we think could mean rate cuts come quicker if that continues to break down and manifest itself in more jobless claims. And it also could result in slowing consumption and slowing economic growth, which we are forecasting.
Right.
Yeah.
Right. And it could potentially feed its way into the labor market signals of our overall recession signal. As you can see here, those numbers still well below their 25% triggering threshold, but something that we'll continue to monitor on the employment side. And that will do it for this edition of CAP STRAT this week. If you have any questions or comments, please feel free to reach out.